Hey guys, welcome back to the second episode of The Mortgage Mindset with Dean Franzese. Last week I had a very special guest, my mentor Keith Cullen. Him and I spoke about some of the changes that this industry has gone through over the last several decades, from social media to all of the technology that these banks have now. And one very important topic that we started to briefly touch on was these non-qualified products. And I don't think there's anybody better than this gentleman right here. His name is Kenny Peskin. He's been at some of the biggest non-QM lenders in the country, and we've been doing business for several years together now. Kenny, thanks for coming on today.
Thanks for having me. It's a pleasure to be here. So I'm Kenny Peskin. I'm with Logan Finance. We're a national non-qualified mortgage player in the country today. Obviously, we've been doing a lot of business together over the years with you guys, so it's been a great partnership. A lot of people do ask us about, the advantages of why organizations such as yourself dive into the non-QM market.
Of course.
The non-QM market is an amazing place to be in all markets, but it is one of the few growth opportunities in the marketplace today. And a company like yours at Hartford, you've done an amazing job of really incorporating the non-qualified mortgage products into your arsenal of products.
Of course.
So as quickly as you're identifying a customer that they may or may not qualify for a traditional mortgage, you're able to pivot into these non-qualified mortgages.
Exactly. And I think that's so important, these last couple of years with all of the volatility, in the market and, a lot of borrowers going through their own personal challenges, I guess, in life. A lot of these programs that, came about the last couple of years, the bank statement program, the profit and loss program from your accountant, those programs gave these borrowers and even their referral partners an opportunity to, get back into the market, to, purchase a new home, to refinance their existing home. I think it really just gave people an opportunity to, again, focus on something they might not have thought they could do in their life because they didn't qualify for a mortgage, traditionally.
That's right.
Based on your tax returns or your income. A lot of business owners that I do business with, they might make $1 million a year, through their business, but once, they do their tax returns, with all of their deductions, their adjusted gross income is not going to qualify.
But you're absolutely correct. So these non-qualified mortgage loans, the large majority of the customers do tend to be self-employed. And the nice thing is that when you're a self-employed customer, you're living the life of a self-employed borrower, right? So what does that mean? You're buying a house when it's time for you to buy a house. Most of our customers are either purchasing properties, whether they be investment properties, or they're purchasing primary residence or second homes, or they're just doing cash out refinance transactions. But these mortgages that they're getting are specific for their life, which is by and large the self-employed borrower. So they need money when they need money. So the point is we're here to fill that void for them. So if they've never filed tax returns, or the tax returns they haven't filed hasn't been for many years, or the tax returns they're filing just don't offer enough, to your point, adjusted gross income for them to qualify, these products are phenomenal because, to your point, what we'll do is we will simply look at those bank statements, we'll calculate an income based on the cash flows of their business, and then you will use that as income to qualify them for these loans.
Exactly. And I think it really, again, gave people an opportunity to, pull the trigger on something that in the past they thought maybe they couldn't do. A great example is, because I've done a lot of business with people who work in restaurants or, somebody in that industry, and these people might be making minimum wage on the books, but between their tips and whatever cash they get from that job, at the end of the year, if we lumped up all of that, or if we lump summed all of that income together, they make enough money to qualify. Maybe not on paper, but they do make enough money to qualify. So, getting into another program that we offer, the verification of employment program, which means your employer is filling out a form that states how much you make. I think, again, it really allowed some of the people who didn't qualify, get back into the market.
You're absolutely right. I mean, at the end of the day, what you're really offering all of these customers is common sense lending.
Exactly.
And it's all solutions-based lending. So if the customer does not qualify for a traditional Fannie or Freddie loan, you have a perfectly good outlets in these non-qualified mortgages. So whether or not they're buying an investment property, a primary residence, they're cashing out of a property, all of these different types of loans that you're looking to provide your customer with, you can provide through these non-qualified mortgages. So whether they're looking for 100% gifts on down payments for investor loans with 2% seller contributions, or whether you're looking to give a self-employed borrower a cash out refi for $2 million all cash in hand, your customers can qualify for these types of loans that the government, that a Fannie Mae loan just won't necessarily afford.
And you brought up a great point, Ken, because I feel like, again, with all the craziness the last couple of years in this business, as many conventional and FHA loans as we still do, your traditional, inside the box mortgage, these loans really allow us to think outside of the box, common sense underwriting. We know we have a business owner or somebody who is earning enough money to pay their mortgage. Just because they can't qualify based on their tax returns, I think, again, this allows them to accomplish their goals and maybe not pay that hefty tax bill that they would have paid that they don't necessarily need to pay.
The non-qualified mortgage products are the great equalizer. So this product will allow all different types of customers, whether their income is transferred, whether their income is flowing through on a tax return, or it's just flowing through on a bank statement. We can take that information and customize a loan with your customers, which we do all the time together. So it's that customization of a loan where we can take a common sense approach and say, they may not really work for this type of a loan, but we can get them to work for this type of a non-qualified mortgage. And that's the value proposition. In fact, what we've discussed many times is that sometimes you'll take a customer that you think is going to take a Fannie Mae loan on an investment property, and you look at them as a full documentation loan for a Fannie Mae loan, only to realize you may get them a better deal with a better terms on a non-qualified investor loan, because that's the game that we're in. So we're in the game of non-qualified mortgages. We're in the game of giving mortgages to the investors. That's what we're looking for. So we're looking to try to solve for those issues. And so we really fit together where the Fannie Mae is leaving off. That's where we can pick up more business for you. The other thing to remember is that the average loan size for these types of loans are significantly higher because you can qualify for more money. So many times we'll see a customer that's a full doc self-employed borrower, and they'll qualify for $500,000 or $600,000 on a mortgage. But when we look at the cash flows of their business, we recognize that they actually qualify for $1 million loan. And so we're able to take this type of a non-qualified mortgage and get the customer into the home that they want and actually can legitimately afford, but they can't necessarily document. And so that's a great opportunity to really be that problem solver for that customer base.
So a very good point that a lot of people bring up when it comes to non-qualified mortgages is, are they subprime loans?
Right.
And I'm sure you could speak on more about the different types of non-qualified products that we have. But from my experience, even going back as far as probably 2017 when I first got licensed in this business and we started doing these non-qualified products, the reason why they became so popular is because there's an ability to repay now. It's not a subprime loan. We're either showing a business bank statement, we're showing a profit and loss from the accountant, which is audited typically. We're showing rental income on an appraisal. So I think the big miscommunication from subprime to these non-qualified products is it's not a subprime loan. There's an ability to repay.
Lots of people do say, is this a subprime loan or some sister product to subprime loans? And the answer quite simply is no, they're not. I mean, subprime products were a very different product under very different terms. Our typical customers have a FICO score well north of 700. Our loan to values, our customers typically have 30%, 25 to 30% equity in these properties. Not only do our customers have really good credit, and in many times they have a lot more equity in these products than some of the other government-sponsored entity products that are out there. When we're talking about a bank statement loan, when we talk about the ability to repay, we're not just looking like on a full doc loan, a snapshot in time, right? When you look at a full documentation loan, you're looking at a W-2 and a pay stub or a tax return, and that's a single snapshot, one day in the life of a customer, okay? When we look at a bank statement loan, we're looking at 12 or 24 months worth of bank statements, and we can look at on that bank statement how they're spending their money and how they're living their life. So we have a very strong sense of what that customer is doing, and as a result of us having a strong sense of what they're doing and being able to document just alternative documentation, because this is just alternative ways of looking at income. It's not better, it's not worse, it's just a different dynamic, okay? And the proof in the fact that it's not better or not worse, that it's just a different dynamic, is the portfolios in terms of their ability to perform. They look no different than any other products in terms of the ability to perform on a pay basis. So we don't see higher default rates, significantly higher default rates in these products that we do in any other product in the marketplace. So it's an amazingly safe product, and the proof of that is that we've gone through some challenging times in COVID, prior to and coming out of COVID, and the customer base has been performing quite well.
Well, even like I had said, going back to 2017 and 2018, when we really started getting used to these loans again, maybe because, I guess the investors just started doing them again. They were a little more lenient in regards to the credit scores and the loan to values back then. Now after COVID and with all of the banks tightening up, I'd say the last year or so, like you said, we're not looking for that borrower who's not going to pay his mortgage. We have borrowers who are putting 20 or 30% down, or they have that equity in their home to refinance.
We are looking at alternative ways of calculating income, and we're looking at alternative ways of coming up with a solution to make common sense decisions that are going to get your customer the mortgage that they're looking for. That's what we're doing here. That's what this entire business model is based on. Common sense lending. We're not just going to look with blinders on and say just because they don't have the income in its most traditional sense, we know that just because they don't have traditional income, that doesn't mean that they're not traditional borrowers.
Okay.
And that's the solution that you're solving for at Hartford, and that's what makes this such a great relationship.
Exactly. Yeah, Kenny, I really appreciate you taking the time today to, come on my show and really speak about how these non-qualified products have not only changed our industry, for consumers, but also helped our referral partners. They helped everybody really produce more business, and it's really amazing to see somebody so educated like yourself in this world. And as time goes on, I'm hoping these programs just become more and more popular. And again, I really appreciate you coming on today, and we look forward to hopefully doing this again in the future.
Thanks very much.